Hello, my name is Nick Quinn.
Hi, I'm Connor Woods.
Hello, I'm Shane Vernier, and we're the market analyst team at howtotrade.com. Together, we'll explain everything you need to know about trading the Wyckoff pattern. All right, let's get started.
Richard Wyckoff developed his theory of market accumulation and distribution back in the 1930s. It's a really interesting concept, and we're going to look at it in this video, particularly how it applies to the end of downtrends where we get accumulation before the market then reverses. His overall theory was called the market cycle theory, and it was basically supposedly where you would be able to then look at price action and see where the smart money was entering and exiting the markets. Now, there's four key stages to the accumulation phase. There's the markdown into the accumulation area, there's the accumulation, then there's reaccumulation before we then get a mark up. Now we're going to look at that in this particular video, so let's jump in and see exactly how we'd go about identifying it. When it comes to identifying Richard Wyckoff patterns on a chart, it really comes down to understanding his market cycle as a whole. That's the whole markdown phase, the accumulation phase, reaccumulation, the markup, and then moving into the distribution phase of how the market cycles round. Now that's quite a deep dive for a short form video like this, but the key point to understand is that we only need to really identify half of that structure to be able to benefit from it in a short-term trading point of view. And that's this: understanding the markdown area, the bearish trend that takes us down to the bottom. And it's this trading range that he really focused on. That is the start of his accumulation phase, where in theory, the smart money in the market is able to purchase stock or purchase the asset in question without actually marking the price up against their own buying, which is the key point that he was trying to make with this theory. Then we move into the reaccumulation phase, which is here. So once we've made a final low here, what he's looking for is this move here. That's part of the reaccumulation phase, which enables the last players to get money in the market, and also serves to wash out weak hands to the downside, as by this stage a lot of retail traders would be looking for the market to now continue lower and make new lows. And then from there the price then gets marked up and the cycle begins again, and the market then starts to trend higher from that point. From a trading point of view, what you would always look to do is to use this, I would say, in conjunction with other tools as well, but you would always basically be looking to buy breaks above the accumulation areas to then trade higher with the market as it moves forward. But it is a fascinating subject, and I would highly recommend that anybody interested in Wyckoff should study it in detail. You can certainly spend a few years doing it, and it would not be time wasted. But the basic principle of how his about how accumulation, reaccumulation, markdown, and markup works, that's basically how to identify it on a chart.
So then let's have a look at an example on the chart. Now, trading the Wyckoff concept, it is a really wide concept. It has no end. It's not just a candlestick pattern. It's also a trading technique that can be used in combination with all other trading strategies. And to be honest, I see it more as a trading theory, but we can use it fantastically on the chart, as you can see right now. So in this Wyckoff pattern, we're looking for four phases. We've got phase A, which is the markdown, phase B, which is the accumulation, phase C, which is the reaccumulation, and phase D, which is the markup. And let me talk you through each one and how we can actually use this in a trade. So we've got phase A, which is the markdown. That's the initial move down in the market, as you can see, from this point to this point. Phase B is this accumulation stage. So after we've got that move to the downside, we can see that the market really traded within a fairly tight range after that move to the downside. That's our accumulation, and therefore we can draw the upper and the bottom of this accumulation as support and resistance. Then what we see is the market fake to break above this resistance line from this phase B, and we've actually snapped back inside. This is what's known as a false breakout. After we get the false breakout, that's when we get this phase C coming into play, which essentially is that reaccumulation. And then after that, we get the breakout above the resistance as confirmation. And then we get the markup stage, which is where traders can really benefit from. Now, if you was going to be trading this, what you could do, similar to other trading breakout strategies, is you could wait after this phase C comes in. So you wait for that false breakout. After phase C comes in, you wait for this phase D, and the phase D is where we can actually act on the market. So we're waiting for this breakout candle. which we can see that we get here from this resistance. We get this breakout candle around here. So let's just draw that on. Around this level. So potentially what you could do is you could wait for a retest of this markup, or you could really just go as soon as you've broken above this trend line that we have here. Let me just extend that so you can see that. Once we get the breakout above here, what a trader might do is go long at the first full body closure above this. Now with your stop losses, probably want them to be sitting in theory below this accumulation phase. So although it's a fairly big stop loss, you could either have it below phase C or below the at the phase B accumulation, this support line that we have here. Now you can actually see that this particular Wyckoff pattern was held for around a 2.2 risk reward trade, and that's with a fairly large and accommodative stop loss. You could tighten your stop loss up towards the phase C, and that would be nearly a 3 risk reward trade. But that's how you can brilliantly use this Wyckoff pattern in your actual trading.
Here are a few of the key pros and cons of the Wyckoff pattern. On the pros side, the Wyckoff is a reliable trading method and charting pattern. Also, the Wyckoff pattern helps traders get a sense of market sentiment and the ability to join large players' positions. And lastly, the Wyckoff works well if used in conjunction with trading volume and momentum-based indicators. Now, on the con side, the Wyckoff pattern often exhibits a lack of clarity and a bit of confusion between the accumulation and distribution phases. Also, in practice, it's not easy to use the Wyckoff chart pattern. It does have an advanced level of sophistication and it requires time and significant study to become proficient in applying the pattern to the live markets. Now, let's review some of the key takeaways from the Wyckoff pattern. Number one, the Wyckoff pattern is considered as one of the core principles of technical analysis. Number two, according to Wyckoff theory, price action moves in a cycle of 4 phases: markdown, accumulation, markup, and distribution. Number three, the key principles of the Wyckoff theory include the law of supply and demand, the law of cause and effect, and the law of effort versus result. Number four, as part of the theory, Wyckoff also created the notion of the composite man. Based on that, traders and investors should have the same mindset as the largest market participants and visualize that one entity controls the asset's price action. And number five, when using this theory, a trader will enter a position at the accumulation phase or when the price breaks above the resistance or support line. A stop loss should be placed at the bottom of the accumulation range, and a profit target could be located at the highest or lowest levels of the previous trend. Now, if you want to learn more about the Wyckoff pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you how to incorporate Wyckoff patterns into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real market price action. You'll have everything you need to practice and gain market experience. Then, once you're ready, feel free to join our How to Trade Funded Trader program.